All right, all right, all right. Good morning, everybody. Welcome to Early Morning Crypto Talk. Bitcoin Brandon from Los Angeles, California. Thank you for taking time out of your schedule for being here. We know there's so many other things you can be doing with your time. It's much appreciated. Go ahead and type in the chat box where you're listening in from. And as a disclaimer, I am not a licensed financial advisor to be giving financial advice. I almost forgot that phrase, and I've been saying that for 5 years. I'm not a licensed financial advisor to be giving financial advice, but I do read the news, give my opinion, share suggestion, and it is up to you to make an informed, intelligent decision on which direction you want to move into. Let's see here. Let's make sure. I should be able to see me here. Oh, I see what's going on. Re-enter the studio. There we go. Gotta make sure I can see you on my other screen. Today is a special Facebook Live because I am streaming this everywhere to the public because Saturday was, we were going to read White Paper of the Federal Reserve. This is a historic moment that is going to go underneath the radar of most people. We are seeing a fundamental shift and change in monetary policy and the future of money worldwide. This is the proposal for this. Nothing this major has happened since the dollar was moved off the gold standard in 1971. So this is the most significant piece of financial change in my lifetime. I was born in 76. Gold standard was dropped in 71. So the gold backed dollar note was introduced in the 30s. So that was before my parents were born. So I thought I was going to be able to cover the whole thing in one day on Saturday, and 2 hours later, I only got halfway through it. So we're going to do it part two today, and I thought it was only fair since I did part one. Although from a marketing perspective, I could have said if you guys want to get part two, you've got to at least be in the inner circle. Yeah, I didn't think about that. I got to put my James Hendricks hat on sometimes. But to be fair, I did have it open on Saturday, so we'll have it open again for today, so everybody can see this. But let me recognize those of you that's here. Let's see. Good morning, Jersey Mike. Van Hairston from Jersey. Is this still your birthday? Can we still count that? Neil Brooks, Richmond, Virginia. Darlene from Durham, North Carolina. Joyce. Good morning, Joyce Easley. Marnita from Colorado. There he is, James Hendricks. #1 Yankees fan is here. That's right, we're in baseball season now, right? Only time I pay attention to baseball is when the Dodgers are about to win the World Series again. Margaretta from Michigan. Faye Harris from Temecula. Patty from San Diego. Chris Shield from Illinois. Doreen from Anguilla. Lisa from Maryland. Janelle, Colorado. Facebook user from Virginia. Anita Suri from Toronto, Canada. Derek from Dominica. Robin Porter, back home in Houston. Welcome back home. Facebook user in Colorado. Facebook user in Colorado. 2 back-to-back. Provis Lofty's Corpus Christi. Fallon. Good morning. Kevin Strouser from Georgia. Dorothy Mays from Tampa, Florida. And like I said, we are streaming everywhere, so everybody's going to get this. Let's briefly take a look at the charts, the market. What is the market doing today? Share screen. Ooh. Yes. All right. Make sure. Okay, if you guys can see my screen, type Y in the chat box. I just want to make sure. Yeah, the group, it doesn't look like I froze. So if you guys can still hear me and see the screen, type Y. Thank you, Pelvis and everybody. I'm still experimenting with multiple screens going at the same time. All right. So, current market cap, we're down 2.8% in the last 24 hours, $993 billion market. Oh, Bitcoin dominance though has fallen. We're at 40.6% now. Whenever you see the Bitcoin dominance falling like this, that means there's a rise in the altcoins. So even with the system down, Bitcoin dominance has fallen. Ethereum has fallen to 14.8%. That used to be up to 18%. Bitcoin is at 21,142. It's still up 0.2% in the last 24 hours. Ethereum is down 0.3%. Now, this is like a flat line 24 hours, basically. BNB and Ripple down a percentage point. Cardano down 1.6. There's a debate going on about Ripple. We all know Ripple is oversold right now because of the lawsuit with the SEC. But with the Federal Reserve coming out with their own digital dollar, because according to what we read on Saturday, they want to be able to eliminate the middleman and use the blockchain rails to be able to do instant cross-border payments. That is exactly what Ripple's designed to do, to work with banks and big businesses to be able to do cross-border payments seamlessly and quickly. So is Ripple going to be a part of that? If it is, then the value of Ripple is going to skyrocket. So you add that, plus they win their lawsuit with the SEC. This might be a sleeper to buy at 36 cents. All-time high is 340, and it hasn't been at that all-time high since 2018. Let me double check. I'm going off the top of my head here. I think it was about 2018. It was at $3.40. Let's see. Yeah, January 7th, 2018, over 40 years ago, and it's 89 cents from its all-time high. So this is a gamble to take. Will Ripple win the lawsuit? Will Ripple be used by the governments? I'm taking that risk. I'm just saying. Good morning, Pat from Texas. All right, let's see the rest of the market here. We've got best performers over the past 24 hours. Chili's is up 7.9%. That's up 18.2 on the week. Tron is up 5.5, 10 on the week. Evmos, I do not know this token. I've seen it. It's up 3.7, but it's up 30% on the week. I don't know about this token. Ethereum Classic is up 3% in 24 hours, 9.1 the last 7 days. Engine Coin is up 2.6, but 32.8% in the past week. Stacks is up 32% in the past week, 10.9 in the last 24 hours. So remember what I said when I was looking at this, and I saw Bitcoin dominance was coming down. That meant the altcoins were having a rise. So this is why it's important to be able to learn how to read the charts. It's like reading a book. You kind of know what's going on before I even get to any of this, and this is showing it. None of these coins are in the top 10. Well, Binance there. Well, that's only up 0.7. So we got Stacks, Engine, Ethereum Classic, Evmos, Tron, and Chili's help boost the market. And even in the past week, look at those. Worst performers in the past 24 hours. Tencent down 11. Thorchain down 9. Matic is down 8, but still up 41.4% on the week. Synthetics Network up down 8. Quant down 8. STEPN is down 8. Airweave, the STEPN was up 26% on the week. So we had a little bit of big reversal also on these tokens. Axie Infinity is down 6. Avi is down 6.8. The Graph, Sandbox, Kusama. All right, well, let's get into the white paper. I'm not going to be opening up my wallets today because we are public, and that is reserved for the inner circle. So we will do that tomorrow. But let's go to the white paper. All right, so we got to page 21. And this section is actually, what's the title of this section? Potential benefits of a CBDC. No. All right. We're on now potential risks and policy considerations for a CBDC. And if you're brand new, that stands for Central Bank Digital Currency. To sum up the first 20 pages, it's just the Federal Reserve giving you basically a history lesson on what money is, the different forms of money that the public has access to, mainly this, but there's other forms of money behind the scenes that the public doesn't have access to, and they want to digitize that and digitize this, and they want to do it through the current banks. So now, for the first time ever, American citizens will actually have an account with the Federal Reserve. Not just with the bank, but you'll have an account with the Federal Reserve. My major reservation about that, as exciting as this is that you're just giving more control and power to the government on your money, and they can freeze and stop it and control it whenever they want to. So I have major privacy concerns and freedom concerns when it comes to digitizing the US dollar, but it is something that is inevitable. The United States wants to remain the world dominant nation, and it does that mainly through the fact that the US dollar is the world reserve currency. Our competitors, I don't want to use the word enemies, our competitors out there want to marginalize the US dollar because they want to marginalize the United States power internationally. So they're looking for alternatives so that they don't have to use the US dollar. So the United States response is, if we want to remain on top, if we want to remain with our influence, then we need to adapt to the changing times, and we need to digitize the dollar and then force the rest of the world to follow suit and continue to use the US dollar just in a new form. So the US digital currency is nothing but fiat currency digitized. Okay? There's a difference between digital currency and cryptocurrency, and it's not about one taking over the other. They're all going to be operating side by side. So now let's talk about the potential risks and policy considerations. Although the introduction of a CBDC could benefit U.S. consumers and the broader financial system, it would also raise complex policy issues and risks. Each of the issues described below will require additional research and analysis. And I got to say this, when you read this report and it says we are looking for more research, we want your feedback. If you decide to go in this direction, we haven't fully committed to this. That's all a lie. This is going to happen. Okay. This is an illusion of choice, meaning acting as if we all have a choice on this. This is going to happen. This is just the first introduction. A CBDC could fundamentally change the structure of the US financial system. It will change the structure, altering the roles and responsibilities of the private sector and the central bank. So what we did cover, there was a question talked about in either Crypto Talk or the 5-Day Challenge. I don't know which one, where it was either Marnita that asked a question about how this is going to change, or well, could digital currency coincide with crypto, and would we eliminate cash altogether? And James brought up a good point. Well, we still have a large percentage of the population that does not have or use technology, like the Amish community and organizations that don't use banks. At one point of the point that this white paper made was that they want to help bank the unbanked. But what about those that aren't using technology? Well, this also said that the digital dollar is not, in its first form, is not going to replace this. Okay, because the first form of it is going to be on the what term did they use? Not commercial side. Hold on, I'm just going to go all the way back up. What page was that? Central bank side. So they talk about three forms of money that the Federal Reserve has: central bank money, commercial bank money, non-bank money. So the central bank money is, you and I do not have access to this. This is where the real money is. We have access to this: commercial bank money and non-bank money. So the first form of this CBDC is going to be on this side, central bank money. Then eventually it'll be on this side. So the commercial bank money, you'll still have, like the Amish community will still be able to operate in this. I believe the way they're going to take this over is that they're going to implement let me not use that word. They will take advantage. That's the word I got to use. They will take advantage of a real or imagined crisis, national or worldwide, in the financial sector. It could be another pandemic that makes COVID look like child's play. Some think that COVID was a dry run, practice run. It could be a major global war. It could be a major global financial collapse, something that puts such a strain on the system that everybody does a run on the bank. And we have another 2008 on steroids happens again. There's a lot that call this, and if you listen to Robert Kiyosaki, the Great Reset. How do you get the people to willingly give up certain freedoms and thank you for it? Well, if the government can come to the rescue to solve a problem that they feel is the only way to solve, whether or not the government created that problem or not. You got to ask yourself, what problems has the government actually really? No, let me not go down that road. All right, central bank money. That's where this digital money is going to start. We are all on this rails here, commercial bank money. But the CBDC is going to give us access now to central bank money. It's a whole new credit system that's going to be created now with the government, not a private. Well, the Federal Reserve is private too. So just with the Federal Reserve. All right. Banks rely in large part on deposits to fund their loans. A widely available CBDC would serve as a closed or, in the case of an interest-bearing CBDC, near perfect substitute for commercial bank money. This substitution effect could reduce the aggregate amount of deposits in the banking system. Why would they do that? Why are they trying to reduce the amount of deposits in the commercial banking system, which could in turn increase bank funding expenses and reduce credit availability or raise credit costs for households and businesses? Similarly, this is the potential risk, okay? An interest-bearing CBDC could result in a shift away from other low-risk assets, such as shares and money market mutual funds, treasury bills, and other short-term instruments. A shift away from these other low-risk assets could reduce credit availability or raise credit costs for businesses and governments. In other words, it's going to be more difficult for the average person to get a loan, to be able to get credit. And the interest rates can end up being sky high if they wanted to, because they're taking now control from the different private banks directly into one source. And if you do that, who's the competition? You know, when you've got Bank of America out there competing with Wells Fargo and US Bank and JP Morgan Chase and all that, you have competition because we have a choice on which bank we want to use. You know, I use multiple banks for different reasons. I've been with Bank of America the longest. They were the first bank I ever had an account with. But sometimes they act stupid with their fees. In my early days when I had no money and, you know, my account went into the negative, or there was 3 or 4 charges on my account in the negative that might have been like $2, I'm getting charged a $30 overdraft fee 5 times. I'm like, what the hell are you guys doing? Well, Mr. Ivy, we take the largest charge first, so to make sure that's covered, and then all the rest. I said, yeah, but you taking that one large charge moves 7 of my account, my charges, $30 each times 7. Had you taken those charges that happened first, then I will only have to pay an overdraft fee on one charge, which was the big one. But they, you know, banks do things a certain way to make the most amount of money. So I can easily take my business to another bank if I don't like what Bank of America is doing. But if we have everything on just one central bank, which is the Federal Reserve, who do we take our grievances to? How do we vote with our feet? Meaning take our money out, put it somewhere else. There is no else. You see where this can go? Let's see. These concerns could potentially be mitigated by CBDC design choices. A non-interest bearing CBDC, for example, would be less attractive as a substitute for commercial bank money. In addition, a central bank might limit the amount of CBDC an end user could hold. Well, first of all, this is a trap that poor people, or let me rephrase that retail people don't understand. I shared the story when I was in Bank of America one day, and they were looking at my account, and they said, "Can we have a private talk with you, Mr. Ivy?" And so they moved me over to one of the cubicles, and they were like trying to pitch me on some next level business account, and if I hold $25,000 in this account for 6 months without going below 25,000, I'm gonna get extra interest on it, and I think it came up to 300 something dollars. Something I said, wait, let me get this right. You telling me that if I hold $25,000 in this account for 6 months, I earn $300? I said, let me, and she said it like excited, like, yes. And do you know an extra $300? Look, you do the grocery store money, gas money, da da da. I said, let me explain something to you. People that make the type of money I make, we're not excited about an extra $300 after six months. The reason I was able to make this money is because I know something that the average person does not know, and I can make better money on my 25,000 doing something different. But that's the trap. So what they're saying is, if you're with the Federal Reserve, you wouldn't have that. You wouldn't be getting interest on your money. And my response to that is, so you're not getting any interest on your money right now. You're losing money keeping money in a bank account. All right. So these concerns, a non-interest bearing CBDC. A CBDC could spur innovation by banks and other actors and would be a safer deposit substitute than many other products, including stable coins. So here's another time they're mentioning the crypto space. Remember, I think we got all the way to page 13 before they even mentioned the word crypto. So now they're looking like they want to, their biggest competition, I guess, in their eyes, is stable coins. So it'll be a safer deposit substitute. And remember, I said too that it looks like they want to use in its initial form the digital dollar as a stable coin to the physical dollar. It looks like that's how they're going to try to roll it out to begin with. So these forms of non-bank money could cause a shift in deposits away from banks, even without a CBDC. So what they're saying is, we need to stop people, instead of holding their money in banks, they're putting it in stable coins. And then they're saying that that's a big risk, because look what happened with Luna, that stable coin. Look what is going to happen to Tether. Tether is still one of my biggest concerns in the crypto space, that is going to cause a huge meltdown in crypto short term. If Tether, or I might say when Tether implodes on itself. The only way to minimize that is you're starting to see this happen. You're starting to see USDC climbing, because Tether used to be almost 80 billion, and people are the whales are like, yeah, make nervous about that. And now they're starting to move it to more secure USDC that has been audited. So this is rising. This used to be on the 20 billion, now it's up to 55 billion. So these are going to flip soon. So if this can continue to rise, the Terra Luna was 45 billion. If we can get this Tether thing down, the lower it is, the less of an impact it's going to have on the entire market when it implodes. But you saw what Terra Luna did at just 45 billion, how that dropped everything. People lost everything. Let me show you something where the difference why I say crypto education is so important. And I say if you refuse to get it, you will lose most, if not all, within 3 to 5 years. See this? I said, and this is why I say over and over again that if you skip crypto education, you will eventually lose most, if not all, of your money in 3 to 5 years in the crypto space. So this is Coinfessions. I was spot trading for 3 years and gained nearly $750,000. So I don't know what he started with, or she, but in 3 years, got their account up to $750,000. And then I lost everything in one Luna trade. What the hell? You put everything on one trade on Luna? This is ultimate greed, because I remember Terra Luna was promised to be the new GOAT in the crypto space. They were doing something amazing. The CEO was running his mouth, and then CZ from Binance, the CEO of Binance, and then billionaires were pouring huge amount of money. This was such a sure thing. This guy probably got FOMO and said, oh, I can hit it big. It took me 3 years to get to 750. I can probably double this in one trade. I'm putting it all on black, like in Vegas. Literally, one Luna trade with X2 leverage and all my savings to buy a house were gone in a single hour. Crypto education would have helped them out there. How about even basic trading education? You don't even have to be crypto educated to know that was a dumb move to make. That when you go to risk it all, you end up losing it all. I've learned. So I'm very, very, very conservative. Who was I talking to? I think Provis was talking about that, or was it Herschel? So yeah, I'm conservative in my moves, but they're a little bit more aggressive. But I'm conservative for a reason. You know, I'm playing the long game. Okay, let's go back. So let's see. Raise costs for businesses. Banks currently rely in large parts on deposits to fund their loans. Okay, yeah, I read that. It's on the shift away from other low risk. Costs. These concerns could potentially be mitigated by CBDC design choices. A non-interest bearing CBDC. Yeah, CBDC can spur innovation by banks and other actors. Oh yeah, so they're looking at this being a shift away from stable coins. These forms of non-bank money could cause a shift in deposits away from banks even without a CBDC. Because central bank money is the safest form of money, a widely accessible CBDC would be particularly attractive to risk-averse users, especially during times of stress in the financial system. The ability to quickly convert other forms of money, including deposits at commercial banks, into CBDC could make runs on financial firms more likely or more severe. Let me read that one more time. That's important. The ability to quickly convert other forms of money, including deposits at commercial banks, into CBDC could make runs on financial firms more likely or more severe. Why? Traditional measures such as prudential supervision, government deposit insurance, and access to central bank liquidity may be insufficient to stave off large outflows of commercial bank deposits into CBDC in the event of financial panic. Oh, there we go. That's what I was talking about. How do you get everybody to adopt this? If there's a run on the bank or there's a financial crisis, people are going to go where they feel it's more safe. And if they think, oh, we can go with the Federal Reserve, that's the ultimate central banking system, our money will be safe over there. Let's give the government all our money. We already gave them all our gold back in the day. They robbed us from it, but we weren't alive when that happened, so I don't even know about it. Let's go ahead and give them all our cash now. As with concerns related to financial sector market structure, some of these flight to safety, that's what, oh, I like that term. Flight to safety. Oh, I don't have my notepad. That's a good thing to write down. Hold on, I wanna write that one down. Because I learn on this stuff. Wait, flight to safety. Oh, here's my pad, and of course, my kid ran off with my pens. All right, I'll make sure. Oh, here we go. Here it is. Okay. That is a term you want to keep in mind. Flight to safety. All right, they're acknowledging this. Some of these flight to safety concerns could potentially be mitigated by CBDC design choices. For example, a central bank could pay no interest on CBDC. Nonetheless, because a liability of the central bank is essentially riskless, depositors may prefer CBDC over bank deposits in a crisis, even if the CBDC has a less attractive rate of return. Okay, first of all, again, and nobody is putting their money in the bank because they're trying to get rich off the interest. That's the lie that they tell people who don't know about money. A central bank could potentially address For example, a central bank could pay no interest on CBDC. Nonetheless, because a liability of the central bank is essentially riskless, depositors may prefer CBDC over bank deposits in a crisis, even if the CBDC has a less attractive rate of return. A central bank could potentially address this risk by limiting the total amount of CBDC an end user could hold. Really? So that's the first time I'm hearing about a limit. Or it could limit the amount of CBDC an end user could accumulate over short periods. Again, that's a form of control. They're saying, oh, well, we're not going to allow you to accumulate so much. The wealthy aren't going to like that. You're putting a limit on how much I can have. Efficacy of monetary policy implementation. A CBDC's design would influence how it might affect monetary policy. Under the current ample reserves monetary policy regime, the federal government or the Federal Reserve exercises control over.
It doesn't look like it's like that fraud.
My other Facebook page popped up on me. Mute that. All right.
Popped up on me.
I'm still hearing myself. Mute
that.
Okay. The regime does not require active management of the supply of reserves. Expected levels of daily fluctuations in the quantity of reserves generally have little effect on the level of the federal funds rate and other short-term interest rates. That's a good question, Kevin. How do you get any less return than we already get from the banks? Yeah, we all know this, but the banks still act as if, and new people that don't know,
okay.
We're taught we need to have a.
The regime does not require active management of the supply
of reserves. Expected levels of daily fluctuations in the quantity of reserves. There we go. All right. Okay, in this framework, the introduction of CBDC could affect monetary policy implementation and interest rate control by altering the supply of reserves in the banking system. In the case of a non-interest bearing CBDC, all right, that's another term you got to hear and play and know the difference. Non-interest bearing CBDC. The only way I see this being an issue is the big boys, the ones who are already working through the central bank, the big businesses and the wealthy. And you got certain accounts in the millions and they're earning interest off of that. The average person working a 9 to 5 job, you're not getting excited off the interest you're making in your money sitting in a bank. But they're gonna be using this as a talking point. So non-interest bearing CBDC, the level and volatility of the public's demand for CBDC might be comparable to other factors that currently affect the quantity of reserves in the banking system, such as changes in physical currency or overnight repurchase agreements. In this case, a decline in CBDC that resulted in a corresponding increase in reserves would only make reserves more ample and would have little effect on the Federal Reserve or federal funds rate. Similarly, an increase in CBDC that pushed reserves lower would also have little effect on the federal funds rate if the initial supply of the reserves were large enough to provide an adequate buffer. Over the long term, the Federal Reserve might have to increase the size of its balance sheet to accommodate CBDC growth, similar to the balance sheet impact of issuing increasing amounts of physical currency. Did you just see that right there? When they say increase the size of its balance sheet, they're talking about making up new money out of thin air. And then they even say it's similar to the balance sheet impact of issuing increasing amounts of physical currency. So the last 40% of all money in circulation right now was printed in the last couple of years because of COVID. 40% new money. So they're saying here in the white paper, we reserve the right to just add more money whenever we want to, calling it increase the size of the balance sheet. You guys get that? So when people say, what's the difference between the CBDC and crypto or Bitcoin? Bitcoin, there's only going to be 21 million ever in existence. That's it. But the CBDC, at any given time, they can press a button and increase the size of its balance sheet to accommodate CBDC growth. This need would be mitigated to the extent that demand for the CBDC represented a shift, directly or indirectly, away from the Federal Reserve's non-reserve liabilities, including physical currency. Additionally, the Federal Reserve would likely need to increase the level of reserves on average in order to provide an adequate buffer against unanticipated increases in CBDC. You'd think if you don't add CBDCs, you just increase the value of it. Wouldn't that be better? No, they make more money the other way. Their goal is not for you to make money. All right? That's not the goal. The goal is for them to be extracting value and money from you. Such surges could otherwise push the aggregate quantity of reserves in the banking system below the ample level and put upward pressure on the federal funds rates. The interactions between CBDC and monetary policy implementation would be more pronounced and more complicated if the CBDC were interest-bearing at levels that are comparable to rates of return on other safe assets. In this case, the level and volatility of the public's demand for CBDC could be quite substantial. Consumers, wait, I read that too fast. Let me go back. It's got to make sense in my head. The interactions between CBDC and monetary policy implementation would be more pronounced and more complicated if the CBDC were interest-bearing. So in other words, they're giving the case on why they're not going to have it an interest-bearing asset like money in your bank. So we're interest-bearing at levels that are comparable to rates of return on other safe assets. In this case, the level and volatility of the public's demand for CBDC could be quite substantial. Consumers, businesses, and potentially others could decide to pair their holdings of bank deposits, pairing treasury bills, and money market mutual fund investments, and increase holdings of CBDC. So they want this to be a store of value. The potential for significant foreign demand for CBDC in this scenario would further complicate monetary policy implementation. Changes in interest rates and other market factors could also significantly affect public demand for CBDC over time. So they're looking at this being like a Bitcoin or gold. To maintain an ample supply of reserves, the Federal Reserve might need to substantially expand its holdings of securities. The potential for market developments to have a material effect on the variability in demand for CBDC could also present challenges for managing reserves and implementing policy. Oh, they're trying to be the center of the universe. What do I mean by that? Well, if they create the CBDC to be in such a way of stability that it is not impacted by other outside market forces, it will always be what it is unless they decide to push a button and create more of it. Then anytime there is a financial crisis in the world or the stock market goes down, and when that happens and people are removing liquidity from the market, then they're now liquid heavy. Where are they going to put it? Is it going to go to gold? Is it going to go to Bitcoin and crypto? Or will it go to the CBDC? I mean, the Federal Reserve. And they say, well, you can trust the Federal Reserve, right? And not only individuals, but what if nations do this? Nations say, yeah, we need to protect our funds, so we're going to make sure we got the United States CBDC, the digital version of this. Yeah, we're not going to get interest on it, but we're not going to lose our money. Beyond these reserve management effects, a rapidly expanding economic literature has considered the broader potential of interest-bearing CBDC as a new policy tool with associated effects on the channels of influence in monetary policy. The issues studied include topics such as the potential effects of CBDC on bank deposits and bank lending, the potential effects of CBDC on the economic decisions of households and businesses, and the possible interactions of CBDC with the Federal Reserve's other tools in conducting monetary policy to achieve its macroeconomic objectives. These and related topics are active areas of research that will no doubt yield additional insights over time. Do you guys have any idea, fathom, because they said something here, why they brought this up? The impact of deposits into bank accounts, because lending doesn't happen unless it has money. The banks can't lend money if they don't have money hitting the bank. How many deposits do you think happen on a daily basis? Not only nationally, even just nationally. How many deposits? Think about it. 90% of people who work a job are depositing their money in a bank. Somewhere around there. So every month you got these deposits hitting banks. What would happen if all of a sudden that gets hit where people are not depositing into banks anymore? See, their fear is people will be turning their money into the crypto side of things. So they say, instead of it going to the crypto, what if we have it go to the CBDC? But if it goes to the CBDC, how is that going to affect the bank lending? Privacy and data protection and the prevention of financial crimes. I was waiting for this to pop up. Criminal activity. Any CBDC would need to strike an appropriate balance between safeguarding consumer policy rights and affording the transparency necessary to deter criminal activity. All right, give me 1 second, because as I told you guys yesterday, my air conditioner unit went out on the hottest day, and I think they were trying to contact me. So give me 1 second. All right, all good. Just let me know what's the update. Okay, so next up here, consumer privacy. A general purpose CBDC would generate data about users' financial transactions in the same ways that commercial bank and non-bank money generate such data today. In the intermediated CBDC model that the Federal Reserve would consider, intermediaries would address privacy concerns by leveraging existing tools. Prevention of financial crimes. Relatedly, financial institutions must comply with a robust set of rules that are designed to combat money laundering and the financing of terrorism. These rules include customer due diligence, record keeping, and reporting requirements. As noted above, any CBDC would need to be designed in a manner that facilitates compliance with these rules. Intermediated models for a U.S. CBDC have the distinct advantage of involving private sector partners with established programs to help ensure compliance with these rules. Operational resilience and cyber security. Threats to existing payment services, including operational disruptions and cybersecurity risks, would apply to a CBDC as well. Any dedicated infrastructure for a CBDC would need to be extremely resilient to such threats, and the operators of the CBDC infrastructure would need to remain vigilant as bad actors employ ever more sophisticated methods and tactics. Designing appropriate defenses for CBDC could be particularly difficult because a CBDC network could potentially have more entry points than exiting payment services. Although securing CBDC would be challenging, a CBDC could enhance the operational resilience of the payment system if it were designed with offline capability. That is, if it allowed some payments to be made without internet access. Huh? How would you do that? Allow some payments to be made without internet access. Okay. Many digital payments today cannot be executed during natural disasters or other large disruptions, and affected areas must rely on in-person cash transactions. Central banks are currently researching whether offline CBD payment options would be feasible. That'll be a big thing. That is something to consider there. What happens if all the power is knocked out? Even if it's short term? What happens if you've got a region that's going through a hurricane and the power goes out for 2 or 3 days, or sometimes weeks, and people need to make a payment or they need to buy stuff and you can't use your credit card? You need cash. So one way or another, cash can't ultimately be eliminated. But then the question is, if everybody is using the CBDC, how will people get their hands on cash? Do ATMs still work when the power is out? But banks could physically open even if the power is out. You can go into the bank and still get physical cash, right? I don't know. You guys tell me if you've gone through that scenario. Seeking comment and next steps. As noted above, the introduction of a CBDC would represent a highly significant innovation in American money. This paper is the first step in a public discussion between the Federal Reserve and stakeholders about CBDC. Like that, Patty. The banks use generators. The Federal Reserve will only take further steps toward developing a CBDC if research points to benefits for households, businesses, and the economy overall that exceed the downside risks, and indicates that CBDC is superior to alternative methods. Furthermore, the Federal Reserve would only pursue a CBDC in the context of broad public and cross-governmental support. The Federal Reserve welcomes comments from all stakeholders on the questions listed below. The Federal Reserve will also conduct targeted outreach and convene public forums to foster a broad dialogue about CBDC. Oh, look at this. Please provide any answers to questions by May 20th. Oh, wait a minute. May 20th, 2022. This just got released. It is not a requirement that all questions be answered. I will put this link that they have in the chat box on my Facebook page. So if you guys are listening to me on my Facebook page, you'll be able to see this. If not, you can always go to my Facebook page to get this link. Paste. All right. Please note all public questions and comments on the money and payments, the U.S. dollar and the age of digital transformation discussion paper, however they are submitted electronically paper form, will be made available publicly. Okay. However, the board reserves the ability to redact information when necessary for technical reasons or to remove sensitive information. All right, CBDC benefits, risks. I only got about 15 more minutes, so it looks like we're going to have another part 3. CBDC benefits, risks, and policy considerations. What additional potential benefits, policy considerations, or risks of a CBDC may exist? Also, these are the questions, okay, that they want you to be able to answer. So what additional benefits, policy considerations, or risks of a CBDC may exist that have not been raised in this paper? Oh, I might want to answer. Well, wait, do I want to? Do I want to contribute to this? Could some or all of the potential benefits of a CBDC be better achieved in a different way? I think that all of these questions is bogus. They already know the answers to this, but they're giving the people like the illusion of they have a hand in this. I might contribute just so that I'm on record. Could a CBDC affect financial inclusion? Would the net effect be positive or negative for inclusion? How might a U.S. CBDC affect the Federal Reserve's ability to effectively implement monetary policy in the pursuit of its maximum employment and price stability goals? Well, if I do contribute into this, then I'm in the system out there. I'm on their radar screen. I got to think about that. So I'm not going to read all of these. Yeah, I can. How could a CBDC affect financial stability? Would the net effect be positive or negative for stability? Could a CBDC adversely affect the financial sector? How might a CBDC affect the financial sector differently from stablecoins or other non-bank money? This is a challenge, though. I want to answer these. What tools could be considered to mitigate any adverse impact of CBDC on the financial sector? Would some of these tools diminish the potential benefits of a CBDC? What if I really do answer this and I create this part of the ILCA playbook? If cash usage declines, is it important to preserve the general public's access to a form of central bank money that can be used widely for payments? How might domestic and cross-border digital payments evolve in the absence of a US CBDC? Crypto. That's how. It's going to happen. It's already happening. How should decisions by any large economy nations to issue CBDCs influence the decision whether the United States should do so? Absolutely. Okay. Calm down, Brandon. Are there additional ways to manage potential risks associated with CBDC that were not raised in the paper? Yes. How could a CBDC provide privacy to consumers without providing complete anonymity and facilitating illicit financial activity? Well, you're trying to be like China? That's a good question, though. How could a CBDC be designed to foster operational and cyber resiliency? What operational or cyber risks might be unavoidable? Should a CBDC be legal tender? CBDC design. Oh, are we right at the end? Okay. CBDC design. Should a CBDC pay interest? If so, why and how? If not, why not? Should the amount of CBDC held by a single end user be subject to quantity limits? What types of firms should serve as intermediaries for CBDC? What should be the role? Oh, I got to go back because my brain was on this. Should a CBDC pay interest? Are you making money off of our money if we buy a CBDC? Are you lending that out? Are you investing the money that we give you? If the answer is yes, then yes, you need to pay interest on that. It's just in my opinion. Should a CBDC have offline capabilities? If so, how might that be achieved? Should a CBDC be designed to maximize ease of use and acceptance at the point of sale? How could a CBDC be designed to achieve transferability across multiple payment platforms? Would new technology or technical standards be needed? How might future technological innovations affect design and policy choices related to CBDC? Are there additional design principles that should be considered? Are there trade-offs around any of the identified design principles, especially in trying to achieve the potential benefits of a CBDC? A whole paper could be written on these answers. Really, if I really had the time, I would dive into this just kind of like for shits and giggles. I don't know. Appendix A, Federal Reserve research on digital currencies. All right, I got 15 minutes. The Federal Reserve is actively researching and experimenting with digital currencies. The work falls into 4 categories: technological experimentation, economic and policy research, stakeholder engagement and outreach, and international collaboration. So they're breaking this down by each category. So technological experimentation. The Federal Reserve is engaged in a number of experiments related to digital currencies, including a hypothetical CBDC. These experiments enrich the Federal Reserve's policy discussions related to digital currency by giving experimenters hands-on experience with the opportunities and limitations of various technologies. Examples of current experiments include building a hypothetical CBDC that would leverage existing technologies and systems. The board's technology lab has been assessing the potential of a centralized CBDC design that leverages existing infrastructure and technology. That's important right there. That's why they kept talking about not getting rid of the banks, but leveraging the system, leveraging the banks. Exploring a CBDC design that would leverage newer technologies such as blockchain. Is this the first time the word blockchain is being used in this entire white paper, 27 pages in? I've always saw cryptocurrency. We saw stablecoin, but I think this is the first time I'm seeing the word blockchain. The Federal Reserve Bank of Boston is collaborating with the Massachusetts Institute of Technology's Digital Currency Initiative to explore the development of alternative platforms. Considering the use of distributed ledger technology for wholesale payments, the board's technology lab has been studying how distributed ledger technology, now remember, distributed ledger technology is blockchain, could be used to support interbank settlement, enhancing existing services to support privately issued digital currencies. The board's technology lab has been studying the use of application programming interfaces to support the issuance, distribution, and use of privately issued digital currencies. Advancing other payments innovation, including payments fraud research. The Federal Reserve Bank of Atlanta is collaborating with Georgia State University and its evidence-based cybersecurity research group on using darknet data to reduce fraud and advancing thinking on key issues. Darknet data. Advancing thinking on key issues related to security, programmable money, interoperability, and standards, among other topics. Economic and policy research. The Federal Reserve is engaged in extensive economic and policy research on digital currencies, focusing especially on financial inclusion and financial stability. The Federal Reserve Bank of Cleveland is creating an academic collaboration that will examine how a CBDC could be designed to support financial inclusion. The Federal Reserve Bank of Atlanta is considering whether cash based and vulnerable populations could safely access and benefit from digital payments, meaning banking the unbanked. Could they benefit for those that don't have a bank account? Stake policy analysts and economists are studying a range of digital currency issues, including privacy considerations and monetary policy implications for CBDCs and private digital assets. Stakeholder engagement and outreach. The Federal Reserve closely follows developments related to digital payments and CBDC in the private sector, foreign central banks, and academia. The Federal Reserve also meets with a variety of stakeholders to understand different perspectives on CBDC. One venue for such dialogue is the Innovation Office Hours hosted by the Federal Reserve banks. These meetings help Federal Reserve staff understand market developments and allow private sector and academic stakeholders to better understand the types of questions the Federal Reserve is considering related to CBDC. The Federal Reserve will expand its public dialogue this year to ensure it solicits a wide range of views. Again, this whole public dialogue is not that they want to get feedback from the public, it's that they are exposing this to the public, getting the public used to this idea, having a discussion about it. They already made up their mind of what's going to happen. International collaboration. The Federal Reserve works closely with other central banks and international organizations to understand key issues related to CBDCs and other payment innovations. The Federal Reserve collaborated with 6 other central banks and the Bank for International Settlements to produce a report in October 2020. You see this? They were already doing this behind the scenes on foundational principles. What year is this? We're in 2022. Let me read this again so you guys understand what's going on. They've already been talking to the rich people about this. The Federal Reserve works closely with other central banks and international organizations. What other international organizations? And other central, who? The IMF? The Bank of England? Who? To understand key issues related to CBDCs and what other payment innovations? See, I like it whenever they go vague like this. The Federal Reserve collaborated with 6 other central banks and the Bank for International Settlements to produce a report in October 2020. That's more than a year and a half ago, on foundational principles for CBDCs. It has continued this work in 2021 with further analysis of policy options and practical implementation issues. The Federal Reserve is also an active participant in work streams supporting the Financial Stability Board's roadmap for improving cross-border payments. In addition, the Federal Reserve Bank of New York has established an innovation center to facilitate collaboration with the Bank for International Settlements on a number of financial innovations. Okay, I got 5 minutes. Oh, this is what I was waiting for too. You see this? You know what? I might have to end it on this one because this is the whole, I don't want to mix this part up and get it halfway in. Types of money. How many of you listened to my live Saturday night? I went over the river of money, and a lot of it I was basing off of new information from this report. Okay, I'm gonna I just want to see the headlines. Types of money: central bank money, commercial bank money, non-bank money. Do I have time to read that like that? Yeah, I do. 5 minutes. Types of money: central bank money. In the United States, central bank money is a liability of the Federal Reserve. It comes in two forms. Whoa, whoa, whoa. Whoa, 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 whoa. You see that? Central bank money is a liability of the Federal Reserve. It comes in two forms: physical currency circulating among the general public, with some held by banks. They consider this a liability. How many times we say it? Putting money in your bank account is a liability, not an asset. So the Federal Reserve is looking at physical money as a liability. Physical money circulating among the general public, and some held by banks. And two, digital account balances held by banks, and a limited number of other eligible institutions at the Federal Reserve. Physical currency has legal tender status in the United States. So understand this. The Federal Reserve, the agency that stole all your gold, is saying that they believe the money in your hand and in bank accounts is a liability. Get that in your head. As of November 2021, there was around 6.39 trillion of central bank money. Of this, 4.18 trillion was in the form of balances at the Federal Reserve, and 2.21 trillion was in the form of circulating cash. Oh my gosh, are you kidding me? I'm glad I have these numbers because they've changed. Are you guys understanding this? Why I say where the real money is? Didn't I say it last week on Saturday? Central bank money. This is where the real money is that you guys don't even have access to. 4.1 trillion. You have access to this. 2.21 trillion. That's circulating cash. Central bank money is the most trusted and safest form of money because the Federal Reserve, as a central bank issuer, presents no credit risk and no liquidity risk. As the safest form of money, central bank money plays an important role as a settlement asset for critically important interbank payment systems. So I said where the real money is, all the banks interacting with each other, the banks bank with somebody, the central bank. All right? Even the banks have a bank. And you don't have access to that. 4.13 trillion. Commercial bank money. Dollar-denominated balances held by consumers in commercial bank accounts are commercial bank money. These balances are liabilities of commercial banks, not of the Federal Reserve. As of November 2021, commercial banks held approximately 4.76 trillion in demand deposits and 13.47 trillion in other liquid deposits. Wait. So look at the numbers here. How can you have 4.76 trillion in demand deposits yet only have 2.21 trillion in circulating cash? If everybody ran to the bank and tried to pull all their money out right now, there's not enough physical cash to go around. That's a run on the bank. We are upside down. We are already in debt. Do you guys understand how precarious our situation is right now? And the Federal Reserve knows this. This is why they're trying to pull this. This is something you guys need to memorize or keep in memory. I've been saying this for years. Balances at commercial banks are also integral to banks. So they're also integral to the bank's function as providers of credit to the economy. Banks extend loans to consumers and businesses, funded in part by the deposits they hold. As of December 2021, there was around 16.41 trillion in bank credit outstanding, but only 2 trillion in money in circulation, reflecting loans and other credit provided to households, businesses, and governments. Today, the safety of commercial bank money is supported by federal deposit insurance, subject to certain limits. a system of prudential regulation and supervision, the access to liquidity from the Federal Reserve. Under this regime, commercial bank money is sufficiently safe that the general public can transact in commercial bank money with confidence that a dollar of bank deposits is easily exchangeable for a dollar of physical currency or a dollar of deposits at another bank. That's only going to work if not everybody runs to the bank. This has not always been the case. In the early 19th century, the principal form of commercial bank money was the bank note. Bank note. And bank notes were often treated very differently depending on the issuing bank. So it wasn't like the dollar that you see right now. See, this is when the Federal Reserve said, give us all your gold and we're going to give you the federal note. But back then, each bank had their own non-bank money. Some non-bank financial service providers also issue liabilities that can be considered money. These providers often hold balances on behalf of consumers or businesses and effect transfers of those balances on their own books for users that have signed up for their services. Monetary market mutual fund shares can be viewed as another form of non-bank money. MMF shares are issued by non-banks, and some MMFs, particularly those offered to businesses and institutions, offer immediate liquidity through the sale of shares, fostering their use as money. MMF shares can also serve as a store of value and frequently are designed to offer investors a stable share price. Okay. Balances held at a non-bank financial service providers are typically supported by specific assets or are backed one-for-one with deposits in a bank account. The public often expects that non-bank money will maintain a stable value and remain readily convertible into both physical currency and bank deposits. But that is not always the case because the assets supporting non-bank money are not risk-free. For example, a decline in the value of a security that backs non-bank money may imperil the non-bank money's conversion into commercial bank money quickly and at a fixed rate. Concern that non-bank money's conversion into commercial bank money quickly and at a fixed rate. Concern that non-bank money will not remain convertible quickly at full one-for-one value may fuel runs on this money. That is, having lost confidence, holders will try to convert out of their non-bank money more quickly and in greater amounts. This puts more pressure on sales of supporting securities or other assets, causing worse losses. Over the years, many forms of non-bank money have succumbed to these types of runs. Indeed, the global financial crisis in 2008 was in large part a crisis of non-bank money, and non-bank money contributed to financial strains again at the onset of the COVID-19 pandemic. While non-bank financial service providers may be subject to certain state regulations, such as money transmitter laws and MMFs, are regulated by the Securities and Exchange Commission, non-bank money lacks many of the protections of commercial bank money. For example, non-bank money issuers are currently not eligible for certain protections against run risk, including regular access to liquidity from the Federal Reserve and federal deposit insurance for customer balances. All right, we're going to stop there. I will continue. We will do part 3 Saturday because that's going to be the next public crypto talk. I got to do my inner circle tomorrow, Wednesday, and Thursday for this, just the inner circle only. If you want to be a part of the inner circle so you don't miss these crypto talks, you want to be a part of that, then you want to, let me put this in here. If you have not done so, register for the inner circle, ilcasecrets.com. You don't want to miss out on this, the inner circle stuff. But I will be back on Saturday morning, and we're going to do part 3. And this should be the last. I'll be able to cover the last 7 pages of this. This is fascinating. This should be required reading for all high school students and all college students. This should be required reading to understand how your money is working in the United States and around the world. 95% of the American population will never even look at this. Unfortunately, it might be even a higher number. But you guys knowing this, you've got to know what money is so that you can see how it's about to change, like the river of money. You may not be able to stop it, you may not be able to influence it, but you can definitely profit from it. Put yourself in a position to profit from it. All right, so I hope that made sense to me. This is like, let me remove, there we go. This is like candy to me. I love learning this type of new information because it's not taught in school. And in certain communities, there's nobody that even teaches it to the communities. You know, this information is learned through families and certain networks. So you guys plugging in, you're putting yourself way ahead of the pack on knowing what's going on and knowing what's coming. As Jim Rohn states, the goal is to build a financial wall of your house so high that nothing can penetrate it. The financial reset is coming. What's happening next? Tonight, I am doing a recap call of the 5-day challenge last week. That's going to happen at 8 p.m. Eastern, 5 p.m. Pacific tonight. 8 p.m. Eastern, 5 p.m. Pacific, recap call for ILCA 5-day challenge. And we're going to be sharing more information about the Bitcoin 101 month for July. Get your hands on the Bitcoin 101 courses for $350. And I am also going to be live training every Tuesday and Thursday nights. Live training on Bitcoin 101 courses. So you don't want to miss that for $350. You get access to all of that stuff. All right, everybody. I'll see you all tonight. My name is Brandon Ivy, Bitcoin Brandon out. Take care. God bless. Bye-bye.